Hello there, I'm Windermere Real Estate's Chief Economist, Matthew Gardner, and welcome to the latest episode of Mondays with Matthew. Over the past several weeks, I've got a lot of messages from you wanting me to discuss the spike in mortgage rates that followed comments by the Federal Reserve, but also asking me if there will be any impacts to the housing market following Russia's invasion of the Ukraine. Now, this is clearly a hot topic right now. So today we're going to take a look at how these events have impacted mortgage rates, but also look at how this may have changed my mortgage rate outlook for 2022. So let's get to it. Here's a chart that shows how rates have moved over the past 2 years or so, using Freddie Mac's average weekly survey for a conforming 30-year mortgage. And you'll see that rates were falling in early 2020, but when COVID-19 was announced as a pandemic, they spiked. But almost immediately, the Fed announced their support for the economy by implementing a broad array of actions to keep credit flowing and limit the economic damage that the pandemic would likely create. And part of that support included large purchases of US government and mortgage-backed securities. And with the Fed as a major buyer of mortgage securities, rates dropped, ending 2020 at a level never seen in the more than 50 years that the 30-year mortgage has been with us. In early 2021, rates started to rise again as the country became more confident that the pandemic was coming under control. But all that changed with the rise of the Delta variant of COVID-19, which pushed rates lower through mid-summer. As we again started to believe that COVID was under control and a booster shot becoming available, you'll see rates resumed their upward trend in August. But what has everyone worried today is this spike that really took off at the end of last year. A jump of almost a full percentage point in just 8 short weeks understandably has a lot of agents, buyers and sellers concerned about what impacts this might have on what has been a remarkably buoyant housing market. Now, rates rising so quickly was unusual, however, not unprecedented. If you really want to be scared, I'd regale you with stories from 1980, when mortgage rates jumped by over 3.5% in less than 8 weeks. Anyway, before we really dig into this topic, some of you may be thinking to yourselves that my numbers have to be wrong because they differ from the rates you've been looking at. But this is due to the fact that the Freddie Mac survey methodology is different from other rate surveys. But even though their rates may not match the ones you've been seeing from other data providers, the trend is still consistent. So let's chat for a bit about what caused the spike in rates. You know, it's always good to have a villain in any story, and the primary, but certainly not sole, culprit responsible for the jump in rates is, you guessed it, the Federal Reserve. As I mentioned earlier, the Fed was the biggest buyer of pools of home loans, otherwise known as mortgage-backed securities, as we moved through the pandemic. But last December, they announced an end of what had been an era of easy money by winding down these purchases in order to lay the groundwork for shrinking their $2.7 trillion, yep, I said trillion, dollar stockpile of MBS paper that they had built up. And this decision to move from quantitative easing to quantitative tightening so rapidly had an almost immediate impact on mortgage rates, simply because the market was going to lose its biggest buyer of mortgage bonds. Immediately on the heels of their announcement, bond sellers raised the interest rate on the bond offerings to try and find buyers other than the Fed. So lenders raised the rates on mortgages housed within these bond offerings. And finally, mortgage brokers moved quickly to raise the rates that they were quoting to the public. The result of all this was that rates leapt. Although we know that the primary party responsible for rates rising was the Fed, but there were other players too. And here I'm talking about inflation. And as you're no doubt aware, it too started to spike at the beginning of this year and now stands at a level we haven't seen since 1982. And if you're wondering why inflation is important, well, high inflation is a disincentive to bond buyers, because if the rate of return, or interest on mortgage bonds, is lower than inflation, well, investors lose interest pretty quickly. So we can blame the Fed, we can blame inflation. But what about Russia? Well, their invasion of the Ukraine on February 24th has certainly influenced mortgage rates, but maybe not in the way you might expect. You see, in general, when there's any sort of global or national geopolitical event, investors tend to gravitate to safety, and this invariably means a shift out of equities and into bonds. So you would be correct in thinking that, at face value, Russia was actually responsible for the tiny drop in rates that we saw following the invasion, and also the more significant drop we saw last week, when the market saw the biggest two-day drop in rates in over a decade. But before you start to think that rates are headed back to where they were a year ago, I've got some bad news for you. That is almost guaranteed not to happen. Given what we know today, the terrible conflict in Eastern Europe is highly unlikely to push rates back down to where they were at the start of the year, but they will, at least for now, act as a headwind to rates continuing to trend higher at the pace we've seen over recent weeks. And that will continue until the conflict is, hopefully peaceably, concluded. And although the Ukraine situation is unlikely to have any significant up or down on mortgage rates, there are some indirect impacts which could negatively impact the housing market. And here I'm talking about oil. Russia is the third largest energy producer in the world, and an already tight global oil supply could get even tighter following newly announced financial sanctions on Russia. A barrel of oil has jumped by almost $20 to $109 a barrel since the start of the occupation. And if this occupation is sustained and Russia is faced with even greater sanctions, well, I wouldn't be surprised to see the price of a gallon of gas rising by between 20 and 40 cents. And it's this, in concert with already high inflation, which will directly hit consumers' wallets, and this itself could certainly impact mortgage borrowing. Okay, so we can blame the Fed, we can blame inflation, and we can blame Russia for the jump in rates. But are the rates you're seeing today really something to lose sleep over? I actually don't think so, at least not yet. Even with mortgage rates where they are today, I look at them and think to myself that they're still exceptionally low by historic standards, and that there really is no need for panic. But let me explain my thinking to you. And to do this, we'll take a look at the impact of rising mortgage rates, not as it relates to buyers' ability to finance a home purchase, but on how it impacts their monthly payments. For this example, we'll use the peak sale price of a single-family home in America, which was just over $370,000 back in June of last year. And to finance this purchase, a buyer was lucky enough to lock in the lowest mortgage rate for that month, 2.96%. Assuming that they put 20% down and are paying the US average homeowner's insurance premium and average property taxes, a buyer closing on that home in June of last year would have a monthly payment of $1,682. Now, what if a buyer had bought the exact same house, but in February of this year? Well, the average rate for the third week of February was 4.06%, a big jump from last June. And higher mortgage rates would have increased their payments to $1,864. What does all this mean? Well, a jump of over a full percentage point means that the monthly payment is more, but only a relatively modest $182. So, even though rates have risen by almost a full percentage point, the increase in payments was, I think you'll agree, relatively nominal. But what if rates had risen to 5%? Well, that would be a very different picture, with payments increasing by a far more substantial $348. Of course, this is a very simplistic way of looking at this, as I've not included any other debt payments that a buyer may have, but I hope that it does demonstrate that even though mortgage rates are certainly significantly higher than they were last summer, because we started from such a low basis, monthly payments have seen a relatively modest increase. The bottom line is that rates were never going to hold at the record lows that we've seen, and we need to simply accept the fact that they will continue trending higher as we move through the year, but are yet at levels that suggest impending doom for the housing arena. So where do I think rates will be by the end of this year? Well, this is my very latest forecast, and given all we know in respect to the Fed and the current Ukrainian situation, my model suggests a significant jump in the first quarter, but then the pace of increase slows significantly. But we will still end the year at a rate that's almost half a percentage point above the forecast I offered at the start of this year. Of course, this is just the opinion of one economist, so I thought it would be useful for you to see what others are thinking. And amazingly enough, most of us, at least for now, are still in a pretty tight range regarding our expectations for the average rate in the fourth quarter of 2022, with Fannie Mae at the low end of the spectrum and the Mortgage Bankers Association at the high end. I honestly believe that, all things being equal, the impact of higher mortgage rates is unlikely to significantly impact the US market this year. And even with rates rising, the market will still remain tight in terms of supply and will continue to favor home sellers. That said, once we break above 4.5%, well, then I'd expect to see that increased cost of financing having a far greater impact, not just on demand, but on price growth too. And if you're wondering why I'm so sure about this, it's simply because we saw the exact same situation in 2018, when rates rose to 4.9%, and we saw a palpable pullback in sales, which dropped from an annual rate of 5.4 million to 5 million units, and the pace of price growth dropped from 5.9% to 3.3%. Now, I don't see rates getting close to 5% for quite some time, and therefore still expect demand to remain robust. Off the all-time highs we've seen for sure, but still solid given demographically driven demand, as well as increasing demand from buyers trying to find a new home before rates rise much further. Of course, the impact of rates rising will not be felt equally across all markets. Many areas, and especially in coastal states, where they've seen home values skyrocket to levels that are well above the national average. And although incomes are generally higher in these areas, buyers in more expensive markets will feel more pain from higher financing costs. And there you have it. I hope that today's chat has not only given you some additional tools to use in your day-to-day business, but has also given you enough information to hopefully ease some of the worry that many of you are feeling right now. As always, if you've got any questions or comments about this particular topic, please do reach out to me. But in the meantime, stay safe out there. And I look forward to visiting with you all again next month. Bye now.